ladies and gentlemen, and a warm welcome for the ones joining us here in the room or the ones joining us online. Today, Rolf and I will present you the results of fiscal year 2025 and outline our assumptions for fiscal year 26 and for the mid-range plan. Before I begin, I assume that everyone has read the disclaimer on page 2, and I will start directly with page 4. Starting with the highlights and market developments. Fiscal year 2025 was marked by a challenging environment. The headwinds clearly affected our order intake, but we could again reach record results, which highlight the strength of our delivery capabilities. Following a strong fiscal year 2024, order intake amounted 784 million Swiss francs, down 32% year-on-year, or minus 27% net of currency translation effects. This reflects the significant market disruptions and the project deferrals across our market segments. Then, supported by a strong order backlog at the start of the year, sales reached 1,057 million Swiss francs, down 3.5%, but actually up 1.3% net of currency translation effects. We further improved our EBIT margin to 13.3%, and we reached with this a new record operating income with 141 million and a new record net income with 110 million Swiss francs, up 4.3%. RONOA increased again to 40.4%, highlighting the value creation from disciplined CapEx management and net working capital management. For fiscal year 2026, we're guiding for sales between 900 million and 1 billion Swiss franc, and an EBIT margin around 12%, with the strongest sales in the second part of the year, and I'll come back to it later. Regarding our mid-range plan, the achievement of the 1.2 billion milestone remains, but is delayed by the current market disruptions. We will communicate the new timing once the market visibility improves. I'll come back to that as well. So let me now set the macroeconomic context. With Liberation Day on April 2nd, 2025, the second day of the fiscal year, this fiscal year was really shaped by the US tariffs and their impact on the Swiss franc and on our customers. The market was becoming even more uncertain with the war in the Middle East in the last months of the year, which happens to be our strongest typically. In the systems division, most regions and segments were affected by these deferred investment decisions. The petrochemical was the most affected, especially in China, where tariff uncertainties have affected both the feedstock and the flow of petrochemical products. In the services division, customers protected their cash and profit by delaying as much as they could, procuring spare parts and upgrading compressors. In addition, security and logistics constraints have led some plants to stop and therefore reducing compressor utilizations. On the positive side, the US service market developed well, supported by energy requirements for data centers and also for LNG exports to Europe. At present, we expect conditions to improve in the second part of the fiscal year 2026, especially in the services division, because customers can't postpone procuring spare parts too long. We've seen that with a big catch-up after the COVID pandemic. Now turning to slide number 7 and looking at the impact on the different market segments. As you can see from the arrows going up and down, 4 segments were negatively affected and 2 went up. Starting with petrochemical and chemicals, which is typically our largest segment, it was the most affected. China especially was facing overcapacity that was still existing last time we talked, but on top of that, the uncertainty led customers to wait to invest further. And projects in the Middle East were further postponed. The one bright spot was India, which continued to grow. In gas transportation and storage, the pipeline remained lively for LNG tankers, even if some decisions were deferred. Uncertainty linked to the IMO regulations remain, and therefore customers are still buying a majority of low-pressure LNG tankers rather than the high-pressure ones for which we have a leadership market position. LPG tankers orders remain at a good level. The hydrogen mobility and energy segments declined clearly in the US after the removals of supportive government measures. China remained very lively, supported by the government. In Europe, it was a year still at a low level, but we see now that the regulations are getting enforced, and we see especially in Germany and in Nordics that the project activity is increasing. Coming now to the growing segments. First, the refinery segment. We saw there limited new investment in traditional refineries, but we saw a big momentum for sustainable aviation fuel refineries. And this is an application where we've been particularly successful, and it's more than compensated for the traditional refineries. Gas gathering and processing remained very active, particularly in the US, Middle East, and Africa. Biogas also, which I mentioned a few times before, was also gaining traction, which makes us very excited about the acquisition of Fornovogas, which I will comment later on. Now, let's step back and look at our fiscal year 2025 in a longer-term perspective. Over the past 8 years, our sales have grown by 6.5% per year in Swiss franc, or 8.5% per year in local currencies. And we've increased our EBIT margin by 13.7% per year on average. This performance was achieved despite currency fluctuations, the COVID pandemic, the Ukraine conflict, and now the US tariffs. Compared to 2018, now if I compare the company, how we are now versus then, we have a much, let's say, more resilient setup. We have a broader product and service portfolio, covering now marine, hydrogen, high-speed, diaphragm compressors. We didn't have that at that time, or much more limited. We also have more services, including digital ones. So now if we try to anticipate our future financials, it's worth looking at the two curves of order intake and sales. We see clearly on the graph that in the past 5 years, we had a book-to-bill ratio above 1, even clearly above 1 in the past 4 years. And with that, we've accumulated a sizable order backlog, which we can continue to deliver in fiscal year 26 and 27. And one special aspect in our business, when the backlog decreases, we see that factories are getting free 1 year in advance, 1.5 years in advance, and with that, we can offer shorter delivery times so that the sales can pick up quicker than order intake has been increasing, actually. These factors underscore the resilience of our business model and our ability to deliver growth through cycles. However, the market disruptions are expected to continue in the next month, and with this, the recovery will most probably not be fast enough for us to reach the 1.2 billion milestone in 2027. In the meantime, that means that we need to continue to adapt to the lower order intake level. Brings me to the next slide. In the current market conditions, we benefit from a resilient setup, as I just highlighted. We are also implementing mitigation measures to strengthen our competitiveness and protect our profitability. In fiscal year 2024, I communicated that at the time, our first response was to accelerate mid-range plan initiatives that improve competitiveness and specific initiatives for growth to compensate for the lower market. In fiscal year 2025, as also highlighted at the half year, we had additional measures, including targeted cost reductions in certain countries and functions. Also workload-based reductions of external and temporary workers. We restricted new hires globally. And we had a simplification of the global functions in the systems division. We also increased our outsourcing to be less dependent on the Swiss franc, which continues to increase. Now, looking ahead to fiscal year 2026, we will certainly have similar mitigation measures during the year. And we will design these measures so that they don't prevent us to recover as the market recovers. Let me now highlight a few milestones for the year. And I start with one of these competitive measures, which is the Fit for Growth program in Winterthur. It has been accelerated in fiscal year 2025, and it helps our factory in Winterthur to remain competitive in the future. On the supply side, for instance, we've implemented a clear portfolio of activities that we keep in-house versus the ones that we outsource. And this has delivered 5% to 20% savings on parts that we have decided to outsource. And with this, we reduce also the dependency on the Swiss franc, and we have a more resilient supply chain with a clear dual sourcing for all parts. We are also securing our in-house core competencies and innovation capabilities, and are modernizing our machine park to be more efficient. The last point on the Car-Labi assembly line, which is these compressors are the ones that we deliver, especially for LPG tankers, ammonia tankers, and there is a big volume of these compressors. We are implementing an improved flow line and also some automation that will enable us to increase the capacity to 500 compressors per year, and we expect a reduction of labor cost and of lead time by at least 30%, as well as a reduction of the footprint for these compressors by around 10%. So all this makes our Swiss factory more competitive for the future. And I would like to highlight one order which shows how we develop in the marine segment and how we protect our market leadership there. We won our largest ever marine order during the year. It was for Hanwha Ocean, the shipyard. It was for 14 large compressors for boil-off gas and fuel gas injections, the one that we know for high-pressure LNG tankers. And they will equip 7 new generation LNG tankers. And what makes this order particularly significant is that it is based on a new compressor platform, which we've developed with the R&D cost we always mentioned. This is for marine. One of the key output of this R&D cost is this new compressor platform. More competitive, also designed for the latest LNG tankers, which have a lower boil-off rate, meaning they require a slightly less large compressor. In addition, we've increased the discharge pressure from 300 bar to 330 bar, which increases the efficiency of the engine and lowers the CO2 footprint. Important as well for us, this compressor has been developed together with Evolens. And with that, we could optimize the overall system for the LNG tanker. That helps the shipyards and then the ship owners to reduce especially energy consumption and the CO2 footprint of these compressors. So this order, I mentioned it because it really highlights our ability to innovate and continue to be on the leading edge on the marine segment. Now let's move to highlights from the services division. In fiscal year 2025, we have significantly improved or increased our footprint with 9 new locations. In the US, for instance, we relocated our workshop in the Northeast, closer to customers. And through the acquisition of ACT, we gained 2 new locations, one close to Chicago, the other one close to Houston. We also set new service centers in the so-called white spots, one in Brazil, one in Japan, one in Vietnam, for instance. In India as well, we've started to build a new global spare parts production center to be closer to customers and to improve our cost position. So these investments strengthen our ability to serve customers locally on a global basis and also makes our service component business more competitive. Let us now look at how artificial intelligence is supporting our service offering. We actually started with artificial intelligence at Prognos about 20 years ago when it was not yet called artificial intelligence. But now what we see as the models are becoming so powerful in the past 2 to 3 years, it really had an impact on our offering. I'll start with the Up solutions, which I mentioned a couple of times here, especially Up Insight, Up Detect. They now use AI models to identify problems before they occur. And with that, they can identify up to 90% of mechanical issues and alert the customer that something needs to be done. And with BC Activate, the second service that I mentioned a few times here, we have included in the diagnostic some AI capabilities. going into our databases, and with that, a report to produce recommendations for the customer, which required a few days for a service technician to write after he had done the diagnostic on site. Now it just needs a couple of hours. And this enables us to bring data, knowledge together, and with that to provide faster, better recommendations to customers. They also start to generate recurring revenues. They make us closer to customers, and they help us address the non-Burckhardt compressors on the service side, which, as you know, is one of our growth opportunities. I would like now to highlight one strategic development which we announced about 1 month ago. We have signed in May the share purchase agreement for the acquisition of Fornovo Gas. Fornovo Gas is a well-established North Italian company with about 120 employees, about 40 million sales Swiss franc, and already 3,000 compressors installed. They manufacture bare shaft reciprocating compressors, skids, container systems, and also provide spare parts and services. The company specializes in modular compressor solutions with a strong focus on biomethane and biogas. So I will highlight on the next slide the significance of this move. Biogas is typically produced in a decentral way from agricultural waste, food waste, or industrial waste as well. That's, for instance, from a beer production. It is then usually upgraded into biomethane, which can be mixed together with natural gas as an energy source. This market is growing fast, at 10 to 15% per year since 2020. And its relevance for energy security has been further highlighted with the conflict in the Middle East. We expect further growth in the same order of magnitude in the coming years, in particular in Europe, thanks to favorable regulations like REPowerEU, and thanks to the existing pipeline infrastructure, which enables the blending of this biogas into the pipeline. So with this strong position in Europe, with this new application biogas, Fornovo Gas will help us grow in the new markets. Fornovo Gas, as I say, also expands our capabilities in configure-to-order compressors by adding an established platform to configure and to deliver compressors in a very efficient way. Going forward, we also plan to leverage our networks, our sales network globally, to sell these compressors in the US, in South America, in Asia, where the market is also growing fast. With this, I close the session on highlights and move to the progress on the mid-range plan. With the usual picture that you know, our strategy continues to be based on the 4 pillars that we communicated at the Capital Markets Day in 2022, strengthening our core business, operational excellence, transforming and building new growth avenues, and enhancing our business foundations. We have made further tangible progress on the 4 pillars, even in a challenging year. We have now completed a few of these strategic goals, like the leveraging of the current footprint and SG&A, which we can see in the RONOA with 40%. We still have some work to do, especially on the serve growth and on the internal digitalization. And for this, we have about 20 initiatives running. And I will highlight now a few of these initiatives and what they have delivered in fiscal year 25. In the Service Systems division, we've made solid progress across all 4 pillars. And I already mentioned a number of these initiatives. And as you can see from the list, which I will not go through in detail, we are currently working with equal emphasis on cost improvement measures and on growth initiatives. Sometimes feels like pressing both on the brake and on the accelerator, but we believe it's exactly the right approach at the moment. And actually one is reinforcing the other, meaning with the cost savings, we get more competitive products, which helps the growth. And we also get savings, which help us fund growth initiatives like new locations. When I go to the Services division, there was also quite some progress, but here the focus is more on the accelerator. And It's also necessary to compensate for the currency translation effects, which are especially strong in the services division because they work a lot in local currencies. And also necessary to compensate the current reluctance of customers to spend. And when I look at the coming years, the growth of the services division will be supported by the acquisition of ACT, by the new locations, by a fast-growing installed base, and by new services, including digital ones. To support this growth, we're also implementing operational excellence initiatives. For instance, with 3D printing capabilities to be faster to deliver spare parts. And also, to be more competitive, we have the new global spare parts production center in India. We also continue to roll out our new services ERP to better steer the business. Let me now highlight the progress on our sustainability roadmap. We made, again, very good progress. And if you look at the list, we are really on track or even ahead of schedule. On climate, for instance, we reduced during fiscal year 2025 our emission intensity, CO2 emission intensity, greenhouse gas emission intensity by 32% in 1 year, and by 55% compared to the baseline of 2021. And with this, we've actually already achieved the goal that we had set ourselves for 2027. And looking at the list, you see that we've already reached actually 6 of the 8 targets that we had set for ourselves for 2027. We will continue to work on the next 2, which also need some support from the market side, from both divisions. On the systems division, we'll need some support to reach the 40% of applications supporting the energy transition. And on the services division, some support to reach the target for upgrades and revamps. And here, actually, our latest 2 acquisitions will help. With ACT, we will increase our share of upgrades and revamps, helping the cyclability and longevity targets. And with biogas, with Fornova Gas, that will help the application supporting the energy transition. With this, I'm closing the first part, and I'm handing over to Rolf, who will present us the financials.
Thank you, Fabrice, and good morning, everyone, also from my side to this presentation. I will now guide you through the financial section, starting with the group financial overview. Order intake was at 784.3 million Swiss francs, down 31.9% year-on-year, or 27.2% net of currency translation effects. This reflects the significant market disruptions and project deferrals across segments caused by volatile US tariffs, strong Swiss franc, and the Middle East crisis that was mentioned before. Sales came in at 1.057 billion Swiss francs. That was down 3.5% in Swiss francs, but up 1.3% net of currency translation effects, supported by the strong order backlog from prior years. Gross profit margin increased by 0.8 percentage points to 28.8%, mainly driven by a more favorable product mix in the systems division. SG&A expenses represented 12.1% of sales, highlighting continued cost discipline and effectiveness of our SG&A spending, which is a key part of our mid-range plan. R&D expenses were at 29.8 million, or 2.8% of sales, which is at a similar level as in the previous year, with continued focus to strengthen our position in the marine markets, developing new applications, and AI-based digital solutions. Other operating income and expenses amounted to minus 5.8 million, mainly driven by negative FX effects similar to the prior year. EBIT reached 141 million Swiss francs, a slight increase of 0.2%, with an EBIT margin improving by 0.4 percentage points to 13.3%, mainly driven by the more favorable product mix in the systems division. Net income reached a new record of 110.1 million Swiss francs, up 4.3%, supported by lower financial expenses and a lower tax rate of 20.3%, which compares to 23.2% last year. With this, earnings per share rose from 31.2 to 32.6 Swiss francs. Let us now look at the Systems division in more details. Order intake was at 476.1 million, down 42.3% or 38.2% net of currency effects. As mentioned before, this significant decrease reflects the market uncertainty from global tariffs, the Middle East conflict that happened basically in the last months of the year, and this affected the final months, which is historically our strongest and led customers to defer major investments. Despite the lower order intake, system sales held up well at 738.6 million, down only 1.4% or even up 2.9% in local currencies, thanks to continued strong operational delivery of the order backlog from the past 3 years. Gross profit increased by 9.3% to 156.1 million, with a gross margin reaching 21.1%, up 2 percentage points, driven by the favorable product mix and high capacity utilization across all our manufacturing and assembly sites. EBIT increased by 16.6% to 79.2 million, yielding an EBIT margin of 10.7%. This represents a 1.6 percentage point improvement, supported by the higher gross margin and strict cost management, and marks for the first time the Systems division a double-digit EBIT margin since its creation back in 2016. Moving to the Services division, order intake was 308.2 million, down 5.4%, driven by the global uncertainties from US tariffs in the first quarter and the Middle East conflict in the fourth quarter. Adjusted for currency translation effects and the ACT acquisition we did last year, order intake was down 0.5% in underlying terms. In other words, service demand was essentially stable as growth in marine and the Americas offset declines elsewhere. Europe and Asia were subdued due to high energy prices and tariff-related uncertainty, while the US market developed positively, supported by energy needs for data centers, LNG exports to Europe, and other things. The marine segment continued to grow, supported by the expanding installed base of ships. Due to the softer order intake and some project deferrals, service came in at 318.5 million. While this represents an 8.2% year-on-year decrease, the underlying performance was more resilient, with a decline of 3.6%, when also adjusting for currency effects and the ACT acquisition. Gross margin decreased by 0.4 percentage points to 46.7%, mainly due to reduced capacity utilization. EBIT margin was down by 0.3 percentage points at 24.4%, with the lower gross margin partially mitigated by strict cost management and lower SG&A cost. On this slide, let me guide you through the cash flow statement. Starting with cash flow from operating activities, which was at 149.4 million, driven by strong cash collection and a further increase in advance payments that we got from customers. While this is below the exceptional prior year figure of 212.8 million, it remains still quite solid. Cash flow from investing activities was minus 29.8 million, related to maintenance capex, IT investments, and the acquisition of ACT in the USA. Cash flow from financing activities was minus 65.9 million, mainly driven by the dividend payment of 60.9 million for fiscal year 24, which compares to 52.5 million in the prior year. Currency translation differences were minus 13.6 million, reflecting significant translation effects on cash positions in our subsidiaries, particularly in China, but also in some other locations outside Switzerland. Borrowings remained stable at 152.2 million, including the bonds of 150 million Swiss francs, which has a term still till September 2028. With this, the overall net financial position improved to 110.8 million, up from 69.6 million providing us with a very strong financial flexibility. With this, our balance sheet continues to demonstrate a robust profile. Property, plant, and equipment basically remained stable, reflecting our disciplined approach on CapEx with limited capital expenditure. The balance between advance payments from customers, work in progress, advance payments to suppliers remained positive at 18.5 million, albeit below the exceptionally high prior year level, which was at 67.7 million. Trade receivables were significantly reduced to 253.7 million, which compares to 356.1 million in the prior year, despite stable sales. That equates to roughly 100 million of improvement through strong cash collection. On the trade receivables overdue more than 90 days, in percentage it increased to 36.4%. Also, the absolute amount remained stable, however, at a high level. Total shareholders' equity increased to 361.6 million, up 21.4 million. With this, the equity ratio has reached 30.7%, surpassing our 30% ambition level for the first time, despite higher dividends paid and a significant negative FX translation effects on investments in subsidiaries. To be remembered, we report on the Swiss GAAP FAIR, where all the goodwill is offset against our equity. Then on this slide, and Fabrice mentioned it earlier, we have a strong value creation at Burckhardt Compression. Our RONOA has almost quadrupled since the year 2018, increasing by over 30 percentage points. This is the result of continued EBIT margin expansion from 7.4% back in fiscal year 2018 to 13.8% in fiscal year 25, combined with a strong net working capital management and a disciplined approach on capital allocation. Our asset productivity has more than doubled since fiscal year 2018, thanks to the leveraging of our existing factory network, with debottlenecking CapEx and operational excellence measures. With this, the business model of the systems division is leveraging the asset base of auxiliaries through the suppliers. That also contributes to our high asset turnover. And as you can see, when comparing our RONOA with peers, which is shown with these dots on the slide here, even if some competitors have a higher EBIT margin, none can match our asset productivity. This is a structural advantage of our business model and a key driver for value creation. Earnings per share have grown at a compound average annual rate of 21.9% since fiscal year 2018, reaching 32.6% in the past fiscal year. Based on these strong results, the Board of Directors will propose to the General Assembly a dividend of 18 Swiss francs, which is the same level as in the previous year and within the group's guidance of the dividend policy, 50 to 70% payout ratio. It is worth to be mentioned that we have paid a dividend every single year since the IPO back in 2006 without interruption. To conclude the financial section, let me reaffirm our capital allocation strategy, which is in line with what we presented to you also in the Capital Market Day back in 2022. On organic growth, we continue to invest in maintenance CapEx, dedicated CapEx to support our mid-range plan growth initiatives. As we speak, we are about to build a factory in India. Fabrice mentioned it earlier. So our approach is still that RONOA has to be greater than the WACC as a key criterion for all these kind of CapEx decisions. On M&A, we remain focused on selective bolt-on acquisitions. For example, our recent ACT acquisition in the US is integrating well, performing to plan, reinforcing our growth strategy, and further to that, you have seen that before. The most recent Vonovogas acquisition is another example. On shareholder returns, we remain committed to our dividend payout ratio, 50 to 70% earnings per share. And on financial leverage, we are slightly above our target ratio of 30% on the equity ratio level, demonstrating a strong and stable balance sheet. With this, I would like to thank you for your attention and hand back to Fabrice for the outlook.
Thank you, Rolf. Let me share now our outlook. I will start with the fiscal year 2026, then discuss our mid-range plan perspective, and close with the global megatrends that support our business. For fiscal year 2026, we expect a slight decrease in sales and profitability due to the ongoing market disruptions. Our guidance is based on several assumptions. On the macro side, we expect global GDP at around 3%, a stable Swiss franc, and no new market disruptions or tariff escalations. We expect the Middle East conflict to ease in the second part of the fiscal year, and the market could then take another 6 months to recover. On the positive side, we have still a significant backlog I highlighted before, and that gives us good visibility. And mitigation measures that I highlighted earlier help us defend our profitability. We also expect a full year effect from the ACT acquisition and about 3/4 from the Phonovogaz acquisition. Based on these assumptions, our guidance is for sales between 900 million and 1 billion Swiss franc, and we expect here stronger sales in the second part of the year due to the timing of project deliveries in the systems division and an expected recovery in the second part of the year on the services division. EBIT margin is expected at around 12%. The decrease versus 2025 is mostly due to lower capacity utilization and a less favorable product mix in the systems division. Now, regarding our mid-range plan, we remain confident to reach the 1.2 billion milestone and the EBIT margin range from 12% to 15%. However, in the past 12 months, the market disruptions has been such that, and also the Swiss franc has also increased, and this disruption lead us to delay the achievement of these targets. And actually, in this context, what we do, and we will continue to work on what we can influence. The service growth based on the strongly increasing installed base, because we sold many compressors in the past few years. The expansion in biogas with the acquisition of Phonovogaz, potential additional bolt-on acquisitions we'll continue to work on, and the development of new acquisitions like CCUS, or the development of new regions like Latin America. But there are other factors which we cannot influence, and on which we need more visibility before we can provide a new timing for reaching the 1.2 billion milestone. One is the resolution of the conflict in the Middle East, and linked to this, the expected catch-up in investment decisions. And we would like here to share some very concrete information so that you see the orders of magnitude. I just took, to highlight how it works, I took the top 15 projects that we had in the sales portfolio at the half year in September. They represented around 340 million Swiss francs of potential orders, so 15 projects, so a bit more than 20 million a piece. When I look at them now, where they stand, we have won 2 of them. We have not lost any, so somehow we had a 100% hit rate. 2 are continuing to moving like planned, so they will be decided in the next few months, and 9 are suspended. So, and these 9, they represent, by the way, and 2 are probably cancelled, which is a normal ratio, I would say, from 15. So only 2 projects have been cancelled, 9 have been postponed, and they represent around 200 million of potential orders, which we are moving in front of us. So we expect that when the condition stabilizes, some of these projects will be reactivated. In addition to this, we continue to watch the decisions from the IMO and also the decisions on high pressure versus low pressure LNG tankers and on the return of the LPG market cycle. So in summary, to be clear, the 1.2 billion sales ambition remains intact, underpinned by global megatrends. It's only the timing which is shifting. So I will close now with these megatrends. Because again, looking beyond the short-term uncertainties, the 3 global megatrends, which are presented already more than 2 years ago, they continue to support our business. And actually, 2 of them are even strengthening as we speak. First, the growing global population, especially the middle class in Asia, drives demand for fertilizers, fuels, polymers, industrial gases, etc. And with this, drives the demand for compressors. Second, the energy security is becoming increasingly important in an unstable geopolitical environment. And we've seen it now. We already have countries in Asia lacking energy. And that will certainly generate new investments to store energy. Pipelines, storage of LNG tankers, storage of LPG tankers, for instance. And in addition, that the countries importing energy recognize the value of having more locally produced energy, which requires infrastructure. And that leads me to the third megatrend, which is the energy transition. We will see more and more investment in energy, sustainable energy infrastructure. That includes solar panel, which continue to grow fast. Even there is still some overcapacity in the production, the installation of solar panels continue to grow at a fast pace. That includes biogas, I mentioned, 10-15% per year growth, green hydrogen, green ammonia, etc. As well, the growing share of natural gas in the energy mix, because it has a lower CO2 footprint than oil or coal, drives demand for compressors. On the service side, we see also an increased demand for monitoring and improving old compressors to reduce the energy consumption, to reduce the CO2 footprint. So all these applications requires compressors, requires services, and with our broad portfolio, global footprint, our innovative capabilities, we are well positioned to take our fair share of these new opportunities. With this, I would like to close our presentation.